Have you ever looked at your investment portfolio on a day when the stock market is deep in the red? That sinking feeling in your stomach is something many of us have felt at one point or another. But while most individual investors are panicking and checking their accounts every 10 minutes, the biggest pension funds and institutional whales are remarkably calm. This is because they are not playing the same game that most retail investors are playing. They understand a fundamental truth that many people overlook until it is too late. In the world of professional wealth management, defense is the ultimate offense. Today, I want to pull back the curtain and show you exactly how these massive institutions protect their wealth during times of uncertainty. We are entering a very specific economic cycle in 2025, where the old rules of investing are being rewritten. If you are over the age of 55, your priority is likely no longer just about hitting a home run with every stock. It is about making sure that the capital you have worked your entire life to build stays exactly where it belongs. It is about prioritizing the return of your capital over the return on your capital. I have spent decades watching how the smartest money in the room operates when the headlines get scary. They do not guess, they do not gamble, and they certainly do not let their emotions dictate their financial future. Instead, they follow a disciplined defensive playbook that allows them to sleep soundly even when the markets are volatile. In the next 10 minutes, I am going to share the 3 core secrets that institutions use to maximize their gains while strictly minimizing their downside exposure. Reinventing the diversification strategy. For decades, we were told that a simple mix of 60% stocks and 40% bonds was the ultimate safety net. This was known as the 60-40 portfolio, and for a long time it worked beautifully. When stocks went down, bonds usually went up, acting as a cushion for your total wealth. However, as we move into 2025, that traditional safety net has some very large holes in it. In a world where inflation can be unpredictable, we are seeing stocks and bonds fall at the exact same time. This means that if you are still relying on that old formula, your portfolio might be much riskier than you realize. Institutions have replaced the old 60-40 model with something called multi-layer diversification. They do not just buy different companies, they buy different types of risk. They are shifting away from traditional paper assets and moving into what we call real assets. This includes things like gold, defensive real estate, and inflation-protected securities. Think of it like building a fortress. You would not build the entire wall out of just one material, no matter how strong it seems. You need layers of different materials to withstand different types of weather. The institutional approach today is about risk parity. This means they balance their portfolio based on how much each asset vibrates or fluctuates, rather than just the dollar amount. If an asset is highly volatile, they hold less of it. If an asset is stable, they hold more. By balancing the volatility instead of just the dollars, they create a much smoother ride for their investors. This is the first step in moving from a gambler's mindset to an institutional mindset. The art of protection and hedging. The second secret that the big funds use is something called tail risk hedging. Most people think of investing as just buying something and hoping it goes up. Institutions look at investing more like a professional sports team or a high-stakes business. They never enter a season without a solid defense and a comprehensive insurance policy. Think about your own home for a moment. You pay for fire insurance every single year, even though you hope you never have to use it. You do not view that insurance premium as a lost investment. You view it as a necessary cost of protection. Professional money managers treat their portfolios with that same level of care. They use a small portion of their profits to buy what we call downside protection. This might involve defensive exchange-traded funds that are designed to go up when the broad market goes down. In the past, this was something only elite hedge funds could do. But in 2025, there are simple tools available to every individual investor that provide this same type of insurance. The goal of hedging is to create what we call asymmetric risk. This means that you set up your portfolio so that your potential for gain is significantly higher than your potential for loss. Imagine if you could participate in most of the market's growth, but your losses were capped at a certain level. That is exactly what institutional hedging is designed to do. It removes the fear of the black swan event, those rare but devastating market crashes that can wipe out years of savings in a few weeks. By having this insurance in place, these large funds are able to stay invested for the long run without ever needing to panic sell. They know their floor is protected, which gives them the psychological strength to stay the course. For someone in their retirement years, this psychological peace of mind is worth more than any individual stock tip. The discipline of automated rebalancing. The third and perhaps most powerful secret of the institutional playbook is the discipline of rebalancing. Human beings are wired to do the exact opposite of what successful investing requires. When an investment is doing great and everyone is talking about it, our instinct is to buy more. When an investment is falling and the news is negative, our instinct is to sell it as fast as we can. This is how most retail investors end up buying high and selling low. Institutional managers remove this human error by using a mechanical, emotionless system. They set a target for their portfolio, for example, 20% in gold and 50% in stable dividend stocks. Every 6 months, they look at those percentages. If the dividend stocks have had a great run and now make up 60% of the portfolio, the institution will sell that extra 10%. They take those profits and they buy the assets that have been underperforming. They are effectively forced by their own rules to sell high and buy low. They do not do this because they are smarter or because they can predict the future. They do it because they follow a process that values discipline over emotion. This simple act of rebalancing is what allows a portfolio to compound steadily over decades. It prevents you from becoming too heavy in one area right before a bubble bursts. It also ensures that you are always adding to the areas of the market that are currently on sale. For a retiree, this system creates a natural machine for generating cash flow and preserving wealth. It takes the guesswork out of the equation and replaces it with a repeatable, reliable habit. In 2025, you do not need to be a math genius to implement this. You just need a calendar and the discipline to follow through on your own plan. Your roadmap to financial peace. As we look toward the remainder of 2025 and beyond, the financial landscape will likely continue to be noisy. There will always be another crisis, another headline, and another reason to be worried. But you do not have to be a victim of the market's volatility. By adopting even a few pieces of the institutional defensive playbook, you can transform your financial life. Start by looking at your diversification and moving beyond the simple 60-40 split. Consider if you have any form of insurance or hedging to protect against a sudden market drop. And most importantly, commit to a regular schedule of rebalancing to keep your emotions out of your money. Remember that the goal of this stage of your life is not to win every single day. It is to ensure that you never lose so much that you cannot recover. The wealthy focus on keeping what they have, and in doing so, they often end up with even more. If you had to choose between a 20% gain with the risk of losing half your savings, or a steady 7% that never drops, which one would let you sleep better tonight? Take a moment to think about your own sleep number, that level of risk that feels right for your family. Financial peace of mind is the ultimate return on investment. Thank you for spending this time with me today. Please remember that this content is for educational purposes only and does not constitute personal financial advice. Always consult with a qualified financial advisor before making any changes to your investment strategy or retirement plan. I wish you a peaceful and prosperous journey ahead.